All right. Well, thank you for all being here. It's quite a crowded room. The acoustics, I know they're bad for you, but they're really bad for presenters because we just get this wall of sound coming at us. So I'm going to be talking loudly, just hoping you can hear me properly at the back. And I'll try to avoid the noise levels I'm hearing coming my own way. So the question I posed in this book is, can we avoid another financial crisis? And as somebody said, it could have been a one-word book, but it needs to be slightly longer. But the basic point is you can't avoid what you can't see coming. And I actually gave this presentation at the OECD, which is, to me, it's actually a compliment now to the OECD that they invite somebody like me to speak at their forum, because of course they were one of the many groups that predicted 2008 was going to be a fantastic year. Well, it was, but not the sort of fantasy they were hoping for. And if you read the Economic Outlook from June of 2007, it was talking about achieving further rebalancing. And their basic prediction was to say that the current economic situation is better than we've seen in years. The forecast is quite benign. There's going to be sustained economic growth and falling unemployment. Now, the reason that I have more faith now in organisations like the OECD, the IMF, the World Bank, the Bank of England, and the Bundesbank, I might add, recently, is that they are on the front line of giving economic advice to politicians. And if you give advice to a politician that ends up having the politician's balls ripped off by the media because the advice was completely wrong, they'll go for your balls afterwards, and much more rudely than the press went for theirs. So consequently, there's been more progress within central banks and treasuries and so on, and institutions like the OECD, than there has been in academic departments, and I think will ever be. I really don't expect academic departments, even with students like yourselves trying to bring about change, to be the centre of that change. It's more likely to be the institutions that are on the front line of giving economic advice. And in the OECD's case, they formed 5 years ago a group called NAEC, which stands for New Approaches to Economic Challenges. So there's progress happening inside the official organs, far more so than universities. And as much as I'm criticising the OECD here, they are trying to devise a realistic economics now. So if you're looking for jobs, apply at the OECD, the IMF, the World Bank, etc., etc. There are possibilities for non-orthodox thinking in economics. One place that's still not possible is the Federal Reserve. And one little insult that I make here is quoting the Federal Open Reserve Monetary Committee chief economist saying that the forecast again is quite benign in December of 2007, which is of course the recorded date for the start of the recession. So the FOMC and the Federal Reserve seems to be more backward, unfortunately, than the OECD, the World Bank, the IMF and the Bundesbank. But that just seems to be an American thing, isn't it? Okay. Now, was it impossible to predict? You'll get arguments from people like David Miles, who was on the Monetary Policy Committee for the Bank of England. He wrote this in this year, so he's still sticking to the script, saying that there is no crisis in economics, because saying that economics got it wrong because they couldn't predict the financial crisis is like accusing statisticians of being hopeless because they can't predict who's going to win next week's lotto contest. Well, that's saying effectively that everything's random, just like a lottery. You simply can't pick it. It's a random shock. But that depends on the theory you use. One of my favourite instances of a theory giving you completely wrong predictions, of course, is Ptolemaic astronomy. One thing they couldn't do was predict comets, but they were okay. They were fine that they couldn't predict comets arriving because comets, according to them, were atmospheric phenomena. Look back and take a look, you'll find that's the case. So they say we can't predict them, they're random events in the atmosphere. We know there's systematic effects in the planetary system on which the Earth rotates around the Sun. And I think neoclassical economics is very much like Ptolemaic astronomy on that front. So what they see as being anomalies and exogenous shocks in the world we actually live in, which you can model using both complex systems approaches and Hyman Minsky's financial instability hypothesis, is that crises like this are the rule. They're endogenous. They're caused by the system itself. And you can see that in an incredibly simple way, because again, what neoclassical economists thought they were doing, and they genuinely and in a sense properly believe what they're doing is scientific. They thought we need a foundation for macroeconomic theory. And the foundation to them is microeconomics. You build up from microeconomics. And that's what they've done effectively with DSGE models. They're trying to derive a model of a macroeconomy by taking a utility maximising household, and a profit maximising firm, maximising utility and profits over the long term, heading towards a bliss point, as it was first called by Ramsey back in 1928, And that's their model of what causes cycles and the return from cycles. It's just shocks to an equilibrium path. What the shock does is disturb where that future bliss point is, and we therefore jump instantly from a current situation to a new location to hit a trajectory that will take us toward this bliss point, and that was the real business cycle explanation for cycles. Now we're getting the DSGE models that have fundamentally the same explanation, only they say there are frictions that slow down how fast you return to this equilibrium, or this, you'll find this new equilibrium path. That's really the innovation. Now, what they didn't realise, and they're still not conscious of it, is their own theories prove you can't derive macro from micro. There's a theorem, if you haven't read it, I highly recommend reading some papers on it. The Handbook of Mathematical Economics has the best summary. It's called the Sonnenschein-Mandel-de Boer theorem. And that shows that if you take a group of individuals who all have utility maximising individuals who each have individual downward sloping market demand curves, Hicksian compensated as the jargon goes, and you add them up, you'll get a demand curve that looks like a polynomial, any shape you like that you can draw by moving a hand along a page and not looping back over yourself and not crossing the curve. That can be a demand curve derived from neoclassical theory. Now they try to evade that result, but it's fundamentally saying you cannot derive macro from micro. But they think is, well, what do you do? Well, the answer is you can derive macro from macro. You don't need to have micro foundations. And to explain that, if you take a definition of the employment rate, which is how many people have a job, divided by population, the wages share of GDP, which is the wage bill divided by GDP, and the private debt to GDP ratio, which is how much we owe divided by how much GDP there is. Those are three strictly, once you've defined them that way, you're working not from a model now, but from strictly true definitions. And if you differentiate that with respect to time, each of those statements, you get these three statements, which are themselves factual statements. It's not yet a model. The employment rate will rise if economic growth exceeds the sum of labour productivity and population growth. That is simply restating the definition of the employment rate in dynamic terms. The wages share of output will rise if wage rises exceed the growth in labour productivity. Whatever causes wage rises, Phillips curve or not, doesn't matter. That is again restating the definition of the wages share of GDP. And the debt ratio will rise. This one's fairly obvious, but as it happens, it's the last one that was obvious to me, because when I first derived the equations, the form of the equation for the debt ratio is quite complicated. And I thought, the other two are straightforward. It's got to be a straightforward explanation. It comes down to simply saying the debt ratio will rise if debt grows faster than GDP. Those are three factual statements. Now, you have to have assumptions to make something into a model. But the neoclassicals, as I remember once challenging a young Turk neoclassical at a Western Economic Association conference, he called out to me as I was walking away from a conversation with him saying, well, we have to make some simplifying assumptions. And I replied over my shoulder, mate, you've got to learn the difference between a simplifying assumption and a fantasy. This is what they basically have. So my simplifying assumptions are, say, production is a linear function of capital. That's roughly right. You can start from that point and make it more elaborate in the future. Investment's a linear function of the profit rate. Now, that's just simply saying capitalists will invest more if they make more profit, and after a certain point they want to borrow money to finance their investment. Obviously it's more complicated, but that's the first starting point. And the third is that wage change is a linear function of the employment rate. Now, that's the dreaded Phillips curve, and it's linear, whereas Phillips said it's non-linear. It's got one factor determining, whereas Phillips said there were three. Nobody ever reads the original Phillips. It's far more complicated and far more realistic than the way it's been parodied by neoclassical economists. But those three simple assumptions, and I say that investment in excess of profits is financed by borrowing from banks. That's been empirically confirmed by, of all people, Fama and French, who are the champions of the efficient markets hypothesis, but empirically they found the strongest correlation with investment, with change in debt, with investment with change in debt. That's a simple statement of that equation. Put that together, and you get a highly stylized model. It can't give you accurate predictions. It can't tell you when a crisis is going to occur, but it will tell you the nature of the crisis. So if you have a low desire to invest, and I'll show this dynamically in Minsky. So in this particular simulation, I have this variable here. If I just zoom in and show you what it is, it's simply the slope of the investment function. And I've kind of got a slope of 5 on it. And this is the employment equation I mentioned to you a moment ago. That's simply stating the employment relationship in a flowchart designed in Minsky, which is system dynamic software. This is the definition of the rate of change of wages, and that's the definition of the rate of change of debt. To show you the equations themselves, Minsky generates these for you. That's those three equations there. And all the parameters are constant. It's pretty hard to get a simpler model than that. I simulate it, and this, when I've got a low desire to invest, I get a nice smooth convergence to equilibrium over time. Okay, the sort of thing neoclassicals think always happen because they believe equilibriums are necessarily stable. So that's a nice stable outcome. But if I hypothesize that capitalists are more willing to invest, then you get this sort of behaviour, and I'll slow it down. That simulation by waveform for 115 years, and you can see there's a convergence to equilibrium going on over time there. If I now start with the higher level of the desire to invest, it initially looks like it's going to converge to equilibrium. In fact, you might even look at that and say, isn't this fantastic? We've got a great moderation going on. Okay, let's sit back and wait to win the Nobel Prize, says Ben Bernanke. Then this starts to happen. The diminishing cycles become expanding ones. Now, obviously, that's not realistic in terms of the scale of it, but if I make it a nonlinear function, if I include inflation effects there as well, I get something very much like what we saw in the real world until government spending rescued us from hitting into a Great Depression abyss. But notice the wages share of GDP is falling, rising inequality because there's more workers and they're poorer than bankers. The actual, even though borrowing in this model is being done by the firms, it's the workers who are paying for it in terms of a lower wages share of GDP. So there's so many real-world phenomena that turn up in this incredibly simple model. And that's what neoclassicals don't realise. They believe that you always tend towards equilibrium. They don't see the non-linearity, they don't see the complexity of the real world. So that's the simulation I've just shown you there. That's running the simulation, I think, for 70 years, and you can see the rate of convergence there in the employment rate towards equilibrium. When I run it when there's a higher desire to invest, that convergence is faster, but then it becomes a divergence. So the Great Moderation and the Great Recession were the same process. Okay? This is what, again, neoclassicals can't actually understand. You see there's rising debt to GDP ratio, rising inequality, and a falling wages share, all of which we've seen empirically. That's the simplest possible model you can derive of macroeconomics, working for macroeconomic definitions, and it's more accurate than the most complicated neoclassical model because it actually catches the interactions between the financial sector, the real sector, and close social classes. So they saw this as a good thing. This is Ben Bernanke, one of my favourite. One of the pities about doing this sort of stuff and publishing academic papers is each time I take the crap out of Ben Bernanke out of this, he gets one more citation in Econ Lib. Pisses me off. Now, I wrote my paper back in August of 1992. The model I showed you I did with nonlinear functions back in 1992. It took 3 years before it was published by the Journal of Post-Keynesian Economics. But at that stage, I thought I was ending with a nice rhetorical flourish where I said, the model shows you shouldn't project stability in the past towards the future. The chaotic dynamics in this paper should warn us against regarding a period of relative tranquility as anything other than a lull before the storm. Now, I frankly thought that was good rhetoric at the time. I didn't think it was going to bloody well happen, but it did. And that shows the depth of this macro-based approach to macroeconomics. Of course, Minsky's financial instability hypothesis is right behind that thinking. But what I'm showing you is you can get the essentials of Minsky's hypothesis just from differentiating macroeconomic definitions. Okay? And it shows you something Minsky didn't know. Minsky did not realise there'd be a great moderation beforehand. In fact, he thought there'd be rising inflation over time. So that's an advantage of doing complex systems work. But what it explains is that private debt is the main destabilising force in capitalism. And of course, mainstream economics has encouraged a rise in private debt. The Modigliani-Miller hypothesis in particular arguing the best situation for a corporation when they don't pay tax and interest is to have 100% debt finance. So there's a huge way in which classical economics softened the world up for far too much debt. When you look at what's happened empirically, this is the American data going back to 1834, British data back to 1880, and then I've included Japan and China and the Euro region for comparison. We have fallen into the biggest level of private debt in the history of capitalism and probably in the history of the human race. And that's all happened under the watch of neoclassical economists who recorded the data but didn't see it coming because according to the theory that data doesn't matter. private debt is a consenting act between adults. You can ignore it, you know. It's actually more like the red light district, which you can't ignore. So that's where we've got trapped, and that's what we'll get it out of to avoid future financial crises. Now, when you look at the causal factors here, and again, this is turned up from the theory that I've developed, which shows the role of both private debt and credit, you can see that the major crises capitalism have all been ones where credit has turned negative. This is looking again at that long-term American data. The red line is the ratio of debt to GDP, and the blue line is the annual change in private debt, which I define as credit. So credit is the change of annual debt, of private debt. Credit's denominated in dollars per year, debt's denominated in dollars. That's why I use the two systems for it. Notice there in 1837, that's called the Panic of 1837. You had a fall of credit going from 10% of GDP positive to minus 10 and a sustained period of negative credit. There's the Great Depression. Same sort of story, from about 8% to minus 10%. And the crisis we've just been through, from 15% to minus 6. So all the major crises in capitalism have been credit crises. But it's been missed by the mainstream because they simply misunderstand the nature of money. So why do they matter? Well, you need to have both high credit and also normally high debt. The 1837 being from a lower level of debt but a very fast rate of fall, because both the stock and the rate of change matter. And you can have a crisis just because the rate of growth slows down. And the basic metric I've now worked out, I made some mistakes in my original logic of trying to get the intuition into mathematically correct form. Aggregate demand is the turnover of existing money plus credit. In terms of Milton Friedman's velocity theory of money, it's V times M plus the DDT. He left out the DDT because he didn't understand how money is created. So if you have a low level of debt, let's say you've got a GDP of $1 trillion a year, growing at 10% per annum, and private debt's 50% of GDP, or $500 billion, and it's growing at 20% per annum. Well, that means in that first year it grows by $100 billion. You add the two together, you get total demand of $1.1 trillion. Now, if next year GDP continues growing at the same rate, so I'm not looking at a feedback through here, just adding them two together, and debt slows down to growing at 10% per annum, 10% of 600 billion is 60 billion. You add the two together, you get a GDP of 1.16 trillion, which is 60 billion more than the year before. Okay, so a slowdown in credit doesn't cause a crisis with a low level of private debt. When you have a high level of private debt, let's say it's 200% of GDP, and that's quite a realistic figure for the current level of debt we're in and a lot of countries which are going to have a crisis in the near future. That's growing at 20% per annum. That 20% of 2 trillion is $400 billion. So that looks like a booming economy. You might call it a Celtic tiger, or what do they call Spain when it had the housing bubble, but it looks like a richer economy than the one without the huge credit growth. So total demand's 1.4 trillion. Now, next year, same story, GDP grows 10%, but the rate of debt slows down to 10% per annum. 10% of 2.4 trillion is 240 billion. You add that to $1.1 trillion, you get a total demand of 1.34. That's $60 billion less than the year before. So this is the real danger. You can't simply stabilise the debt ratio. That won't end your problems because that will cause a fall in demand. That's what the mainstream is not aware of. So both matter. And to show just what it looks like with the United States, this is looking again at the level of debt, the red line, and the annual change in debt, the blue line, credit. And the only time since 1945 that America's had negative credit is the Great Recession. Now, if you look at Stiglitz and all the mainstream people, they still haven't understood this. They still argue the aggregate level of debt doesn't matter, it's just distribution that counts. They're wrong. Okay? They're simply wrong, and it's time we stop pandering to them with little things like Nobel Prizes. So there's first negative credit since the Great Depression. And when you look then at they argue there's no correlation. Bernanke actually said that there'd be no effect between credit and macroeconomic variables. No effect with a correlation coefficient of minus 0.91 over 30 years. I'm sorry, that's significantly different from zero. And in housing prices, when you look at mortgage debt, acceleration of mortgage debt or change in new mortgage debt causes change in house prices. And we've done Granger causality on this as well, by the way, much to my amazement, since it's a linear test, which it's more likely to reject causation in a genuinely non-linear model. We got a strong Granger causality test saying acceleration of mortgage debt causes change in house prices, not vice versa, which I didn't expect, but that's what the data gave us. Now, what we've got for all these countries that have had a crisis, Japan, the USA, UK and Spain, they've all had negative credit. So you look at Japan's crisis back in 1990, that's down here. Notice the negative level of credit, a huge level of credit, heading negative over time, predominantly negative since then. Spain, enormous credit bubble, 35% of GDP was the last increase in credit before it started turning negative, down to minus 20%. That's why you've got 25% unemployment in Spain, or why you had it at the time. America, the same sort of story. The countries that didn't have a crisis avoided it by continuing to borrow money. So here's China, Canada, South Korea and Australia. Their credit levels. You notice there's a couple of periods of negative, but since the global financial crisis, which is here, they've all had credit which is above zero. So they've avoided the crisis by continuing to borrow money. Great idea. All they're doing is putting it off to later because they now have a higher level of debt than they would have had at the time of the global financial crisis had they had policies would let that crisis manifest itself as happened in America. So there's America, which peaked at 1.7 times GDP as a debt level, is now at a 1.5 but rising again. You can see China went from 115% of GDP to 210%. Okay? That's where the China boom came from. Similar sorts of story for Australia, Canada and so on. So what are the precursors for a crisis? Here I'm relying on work by Richard Vague. If you haven't heard of Richard, learn what he's been writing about. He's a philanthropist and banker, very successful banker, is now a critic of private debt, running a thing called the Private Debt Project. You can find one of its stands back here. Richard's speaking on the weekend at the INET conference, if any of you are going to it. Do look at his research. So he's done empirical work looking back over 150 years at roughly 150 crises around the world, and the general parameters he found empirically were crises occurred when the private debt level exceeded 1.5 times GDP, and when that ratio grew by 17% or more over a 5-year period before the crisis. So looking at that and saying which countries qualify for a crisis in the near future, you won't be surprised to see China topping the list. Okay. Over the last 5 years, China's debt level's risen by 63% of GDP, from a fairly low level, relatively, 148%, still near the crisis, to 210%. Canada, 35% change in its debt level. South Korea, 12%, but it's well and truly past the danger zone, 193% of GDP. Australia, 22% increase. Sweden has got a huge level of private debt. Its credit contribution is quite small, but I think it sets it up as a possible one for it. Belgium, I had no expectation that I'd find Belgium in the data. This is all using Bank of International Settlements data. That's not the complete list. Other potential countries that are in there are France. Happy birthday Macron when this happens to him. So France qualifies on that front. The Netherlands has got a huge level of private debt. It's more likely to be stagnating than have a crisis. Singapore is the one I'd add most recently. The most recent data from the BIS recorded a dramatic increase in private debt in Singapore, so it's another one that qualifies. But all those countries are possible. And I'm now going to ask my controller here whether I should stop talking. Keep on going? Okay. I hope your head's having a good spin here. Okay, I just want to spin you a bit further because the mainstream approach to this, apart from quantitative easing, has also been to impose austerity. Remember the days of what they call expansionary fiscal austerity? Wasn't that a great slogan? You see the comedian who was acting over there? He hasn't worked on that one yet. We should get him doing something on expansionary fiscal austerity, showing how you can get fatter while you eat less food. Anyway, so this is Theresa May. We should live within our means. And the reason people fall for this, they extrapolate the individual to the collective again. So if you imagine yourself earning $200 a year and spending $200, I think I've got pounds in this data here, given the country I'm in, and you go the next year to spending £10 less, you're going to save £10. That's great. Let's all do it. That's the sort of theory. So you start from zero, you spend £10 less, you put away 10 for a rainy day. Excellent. That's the sort of logic we all use at the household level. But what does it look like from the point of view of other sectors in the economy? Now, this can be Tom, Dick and Harriet, as I use in examples. It can be Germany, Spain and Portugal. It's any three sectors which interact with each other and you give a cohesive economic unity. When you look at this point of view of Sector 1, Sector A was spending 200 one year, and the next year it's spending 190. It's spending 10 less collectively on the other two sectors. So it's managed to save 10 by reducing GDP by 10. And the fall in GDP has been worn by the other sectors. Now, if they all decide to do the same thing, if they think, well, let's also try to save in that same situation, then what actually happens is the saving by one sector becomes an identical fall in income, the aggregate. Your saving is somebody else's decline in income. Your expenditure becomes somebody else's income. If you spend less, other people earn less. And that's the fallacy of applying this idea at the national level, at the macro level. So when you take a look at that, imagine if the other sectors do the same thing. Currently, you start with a GDP of £600, which is the expenditure and the income of those three sectors added together. When they're each spending and earning 200, they all decide to save 10. So you go from this situation, the negative of the diagonal, by the way, is expenditure. The sum of the off diagonal is the aggregate income measure of GDP. So sector A, first of all, gets you to this situation. So it's spending 190 and GDP's fallen by 10. It's saving 10, but the other sectors have got -5. So if they all decide to do the same thing, you go from a GDP of 600 to a GDP of 570. So austerity actually reduces income. That's the huge mistake. And it's a logical error made by economists who tell us how to manage money when they have models of the macroeconomy that leave money out of them. Why the hell are we listening to them? We need a new monetary economics. So this is the whole problem. Entire economies can't save. Now, how can you actually save money? What's the right thing for the government to do? Well, imagine we have three sectors that are all trying to save money. They all would like to save 10. Well, they can do that if there's another sector, which has got question marks to it, that spends 10 more than it earns from each of them. So it earns 10 from each, but it spends 30. And that means those sectors gain 10 each. Well, it gets a -30. Who can do that? Well, banks could do it, of course. Banks can lend to you more than they get back in repayments from you. And that's great. You get a £10 extra, but you also get a £10 debt extra. Your personal position has not improved. But if you have the government doing it, the government spends more than it takes back in taxation, that's going to increase your bank accounts by 30. And there's no increase in your debt. If the government pays you to build a building for it, it doesn't give you a debt for the money it gave you for building the building. Okay? There's no way that the government spending causes you, as the recipient, to have an equivalent debt. So that's the difference for us. It's an asset that comes to us without a liability, but the government's got a liability. So how does it finance that? Well, it happens to own its own bank. And this is what we tend to forget. The government doesn't do this, it can't do this directly. It's banned by it from legal requirements put in place by lawyers advised by neoclassical economists. But fundamentally, when the bank operates open market operations and so on, it is fundamentally doing this in a two-step process. The government sells the bonds to the private sector sells the bonds to the central bank. So I'm jumping over those two stages and saying, if the government wants to spend 30 more than it's getting back in taxation, then it can issue bonds worth 33, use 30 of those to do the spending into the private sector, and use 3 of that to pay interest to the central bank. So in that sense, the government running a deficit, the interest on that deficit increases the equity of the central bank. And then that enables the government to spend on the real world. So it's a delusion to think austerity works. If you actually do it, what's happening is the government is spending 10 less on each of those sectors. It's accumulating a surplus, but those sectors accumulate a deficit. And that drives the rest of the economy into a deficit which you can only cover by borrowing money from the private banks. And you tend to get, as a result of it, when there's been major surpluses by the government, it's not a purely causal relationship, but this has meant that in the aftermath, rather than saving for a rainy day, it causes a hurricane. Because the 2 times in the American data, you can find that the American government ran a surplus, a sustained surplus, for the 1920s and under Bill Clinton. After the 1920s, we had the Great Depression, and after Bill Clinton, of course, with some time lag, courtesy of George Bush being slightly, well, I saw a little tweet saying today that so far, Donald Trump hasn't done anything quite as stupid as George Bush, okay? I don't know if it's going to last, but, the Iraq War caused the government deficit. But if you look at the American data, this comes straight direct from the White House, that point there is 0. So anything above that is running a surplus. There's the 1920s, there's the 1930s, okay? And that's the Second World War. So the 1930s there and the Second World War. That's why we got out of the financial crisis of the Great Depression, because of the scale of government spending to finance the Second World War. So when you look at the average deficit has been 2% of GDP, 2.4%. If you take out World War II, it's 2.1%. So despite all the rhetoric about trying to run a surplus, the government has normally run a deficit, and it should normally do that because that's creating part of our money supply. If it doesn't do it, we depend upon the private banks. We get involved in a private bank debt bubble, like the stock market bubble of the 1920s, or the dot-com and then the subprime bubble of the 2000s, you end up in a financial crisis. So we need a bit of realism in economic theory, and we can't understand capitalism by pretending it's a barter system. We have to use the wisdom that Hyman Minsky is saying, that the real question in economics is, can another Great Depression happen? We've already answered the question. The answer is yes. Okay? So why didn't it occur? We have to answer that question as well, and we can't do it with an economic theory that can't generate a Great Depression as one of the possible states of a capitalist economy. And we know that's got one of those states, and we're in the aftermath of that right now. Thank you.